Chapter 4, Individual Income Tax Overview, Exemptions and Filing Status. This is a handy slide to have for reference, just showing the overall formula for calculating individual income tax. So you might want to save this one specifically. You will become, by the end of this semester, quite familiar with the 1040 form. It is the starting point for all individual tax returns. To it, you will find that you add to it certain additions, and in some cases use an abbreviated version of the form based on complexity or simplicity of the tax case. Under U.S. tax law, the assumption is that pretty much everything is included in income. Excluded and deferred income are the types of income not included for tax purposes, and depending on whether the exclusion is temporary or permanent, it would fit into one of those two categories. In calculating tax liability, it's oftentimes necessary to determine the character of income or loss to determine if something is taxable, and if taxable, at what rate. For individuals, generally, all assets are considered capital assets with these exceptions that you see on this slide. And you'll see why that's important as we move forward. Capital gains and losses arise from the sale or disposition of capital assets and can vary based on the nature of capital gain or loss in terms of how they are treated for tax purposes. You will hear in this course and in practice the term above the line deductions very often, above or below the line. The line in question is AGI, or adjusted gross income. So above the line means taken before calculating, so deductions taken before calculating AGI, and below the line means taken after calculating AGI. That's why it's for AGI, for the calculation of AGI, or from AGI, meaning you're going to reduce AGI further. This is important because AGI is used throughout the tax code as a threshold in many other areas of taxation. So you'll use AGI as a reference and be given maybe a percentage of AGI or some other amount related to AGI that you'll use to calculate other parts of your tax calculation. So AGI is, or whether a deduction is from AGI or for AGI, is important for various reasons. Not only in the calculation of AGI and the actual deduction in question, but also in using AGI as a threshold for other components of tax calculations. Standard and itemized deductions, when you hear those terms, those are referring to the deductions made below the line. If your standard deduction is higher or more than your itemized deductions taken together, then you just use standard deduction. These standard deductions vary year to year most of the time. So, knowing exactly what they are is not always necessary. Knowing approximately what they are is nice, and that doesn't change a whole lot year to year. So having a general approximation will serve you well. And then you usually will refer back to some chart or reference for actual amounts. Now, obviously, if you're doing 500 tax returns in a tax season, eventually you will internalize what this year's exact amounts are. We talked a bit already about what it means to have a progressive tax rate schedule. It means as taxable income goes up, tax rates also go up. Generally, items that are taxed at preferential rates, and we already talked about this a little as well, are set up that way as a way to use the tax system to either encourage or discourage behavior. We'll spend more time individually on each of these other taxes listed, and specifically on the use of tax credits later in the chapter and in the semester. For most people, tax prepayments are the withholdings that their employer has taken out of their paycheck based on the information that was provided by the employee on the W-2 forms. So obviously when you're filling out your W-2 forms, you will list your exemptions on there, and based on the amount of dependents you have and the other information that you've put on your W-2, the amount your employer will calculate how much they expect they should have to withhold from your earnings. At the end of the year, that's not always exactly accurate with respect to your overall tax liability. So at that point, you will either owe, or for most people, if you're just an employee and don't have any other complications, you will either owe slightly more or receive back the amount that you overpaid in your withholdings, and that will be your tax return, or your tax refund, I should say. The exemption amount is another area that fluctuates from year to year, but generally is in the same ballpark. And you will get a certain number of personal exemptions for yourself, and if you're married, for your spouse, and then other exemptions for those individuals that qualify as your dependents. In order to be considered a dependent, generally this last bullet point is what you're looking at. You either need to be a qualifying child or a qualifying relative of the taxpayer. Now, in order to be one of those two, these are some of the things that cannot be true about the qualifying child or qualifying relative. Okay, but those are not the only tests that go into that. For the qualifying child, you've got a relationship test, age test, residence test, and support test. We'll go through those one by one. This is the relationship test. This is the age test. I'm not going to cover this in any more depth because it's really just as simple as looking at these stipulations. Then you have a residence test and a support test. Here's an example of a qualifying child situation. Rodney and Anita have 2 children, Braxton, age 12, who lives at home, Tara, age 21, who is a full-time student and does not live at home. While Tara earned $9,000 in a summer job, she did not provide more than half of her own support during the year. Are Braxton and Tara qualifying children to Rodney and Anita? Well, just plug them into those tests. Do they meet the tests? In each case, they do. So both of those individuals would be considered qualifying children. Tie-breaking rules. Okay, so this is the scenario if more than one individual could potentially claim another individual as a qualifying child. So in other words, you have more than one taxpayer who can look at these tests and say yes to all of them for the child or individual in question. If that's the case, you go over these tie-breaking rules from top to bottom here. First you look, if one person is a parent and the other person is not, then the parent wins. Okay? If each parent, or if the individual lives with each parent for a portion of the year, you would then look at which person or which parent the child lives with for more days of the year. Finally, if all of those are equal, you would look at whoever has the higher AGI as the final as the final tiebreaker. So the person with the higher AGI of the two in question would get the exemption. Another qualifying child example. Braxton's uncle Sean, who's Rodney's brother, lived in the Hall's home, the same home Braxton lived in, for more than 11 months during the year. Does Braxton meet the requirements to be considered Sean's qualifying child? Well, let's plug him in here. Does he meet the relationship test? Yes. Age test? Yes. Residence test? Yes. Support test? Yes. Braxton is considered to be Rodney and Anita's qualifying child and Sean's qualifying child. Under the tiebreaker rules, who is allowed to claim Braxton as a dependent for the year? Well, what's the first rule? Tiebreaker rule? Parents. Okay, so in this case, Rodney and Anita are the parents. You don't have to go any further down the list. Okay, now let's look at qualifying relative. This is similar to a qualifying child in the effect of having one of these individuals on your tax returns. It qualifies as a dependency exemption, but the tests are slightly different. Okay, so first test, relationship test. Okay, these are the qualifications. Next, you got a support and a gross income test. Those are the qualifications. Let's take a look at an example. John is a 22-year-old student who has lived in the dorms for most of the year but spends the rest of the year living with his parents. He earned a $5,000 scholarship for the school year and has worked hard to support himself through school, earning $6,000 to pay for his own expenses. His parents have supported him by paying for $7,000 for food, clothing, and lodging expenses. Are John's parents able to claim him as a dependent? Okay. We're looking at both the tests here, qualifying child and qualifying relative. Okay. So, does, what was his name? John. Does John qualify under the qualifying child test? Under qualifying child, relationship, yes. Age, yes. Residence, yes. Support, yes. There is no gross income portion of that, so yes. Qualifies for all of the qualifying child tests. How about qualifying relative? Relationship, yes. There is no age or residence test there. Support test, yes. Gross income test, no. So this person fails as a qualifying relative. But as a qualifying child, yes. Okay? So, now we're going to look at filing statuses. You have these 5 different filing statuses. We'll look at each one of those. To be married filing jointly, these are the stipulations. Okay? Must be married on the last day of the year, or another way to look at that is you only care about status as of the last day of the year, with the exception of having a spouse die during the year. Okay? Under married filing jointly status, you are jointly and severally liable for the tax. This means you are essentially viewed as one individual, regardless of if there's liability that's attributable only to one or the other spouse. You're still either spouse could be considered liable for that. Married filing separately, okay? Typically not beneficial from tax perspective, so typically if you can avoid it, you're not going to file that, okay? There are some non-tax reasons that it might be beneficial. For instance, from a legal liability standpoint, there's no joint and several liability, okay? So if one spouse is fraudulent on their tax return, the other spouse is not going to be liable for that. And there are some protections against that even in a married filing jointly situation if it can be proved. But just on the face, you're not liable for your spouse's tax situation if you're filing separately. Okay, qualifying widow or widower. This is a beneficial filing status available to qualifying widow or widowers if they meet those stipulations. Single, unmarried, unless you can qualify for head of household. So if you're not married, you are considered single unless you meet the head of household stipulations. Again, head of household is another beneficial or more beneficial than being single tax filing status. These are the stipulations. Qualifying purpose for the purposes of determining head of household, those are your options there. Okay, so you can be a qualifying. You can either have a qualifying child or children, or a qualifying relative who is either the taxpayer's mother or father. So not all qualifying relatives, for purposes of determining exemptions, not all of those same people would qualify or allow you to qualify as a head of household unless they're your mother or your father. If they're not your mother or your father, then you have these added hoops to jump through for a qualifying relative. This is the situation where you can qualify as head of household if you are a married person who has had a spouse abandon them, assuming these all apply to your situation. Assume that last year Rodney passed away, and during the current year Anita did not remarry but maintained a household for Braxton and Tara, her dependent children. Under these circumstances, what would Anita's filing status be? Well, you're going to look at each of those possibilities. Rodney passed away. Anita did not remarry. Okay, so right there, you know Anita was married to Rodney. Okay, so you're going to look, okay, you're going to think to yourself, well, do any of the married statuses apply? Okay, then you're going to look and say, well, if none of those apply, what about head of household, qualifying widow or widower? These should be kind of red flags to get you to think about those individual scenarios and plug her situation in and see if she qualifies. In this case, she would qualify as a qualifying widow because of the timeliness of Rodney passing away. Another one, assume Rodney and Anita divorced last year. During the current year, Braxton lives with Anita, and Anita pays all the costs of maintaining the household for herself and Braxton. Under these circumstances, what is Anita's filing status for the current year? Well, since they divorced last year, you know married filing jointly or separately is off the table. Okay, they divorced, so as of the last day of the current year, she's not married. Anita and Rodney are not married, so the married statuses are not going to apply. So most likely we would look at head of household and see if she qualifies for that. In this case, since she meets the qualifications under head of household, that would apply, and that would be the most beneficial filing status she could have. Okay. So generally, you're going to start at the most beneficial filing status and work your way back. Okay, that's the easiest way to do it. And of course, once you internalize these a little bit and have done some of these in practice, the answer will just jump into your mind when you see the scenario. Final example here, assume Sean, who's Rodney's brother, lived with the Halls, but Sean paid more than half the costs of maintaining a separate apartment that is the principal residence of his mother, Sharon, whose gross income is $1,500. Because Sean provided more than half of Sharon's support during the year, and because Sharon's gross income was only $1,500, she qualifies as Sean's dependent as a qualifying relative. In these circumstances, what is Sean's filing status? Okay. So again, we're going to look at the most beneficial status that Sean could possibly have. And in this case, let's see. I'm trying to see if Okay, so in this case, we have no information about Sean being married. So most likely here, head of household would be the most beneficial status that he could have. So in this case, we would look at head of household first, and we would see if Sean meets those qualifications. And Sean does, because Sean paid more than half the costs of maintaining a separate household that is the principal place of abode for his mother, and in this case, his mother qualifies as his dependent, so he can qualify for head of household status.